A company form of organization is the third stage in the evolution of forms of organization. Its capital is contributed by a large number of persons, called shareholders, who are the real owners of the company, but neither it is possible for all of them to participate in the management of the company nor considered desirable. Therefore, they elect a board of directors as their representative to manage the affairs of the company. In fact, all the affairs of the company are governed by the provisions of the Companies Act 2013. A company means a company incorporated or registered under the Companies Act 2013 or under any other earlier Companies Acts. According to Chief Justice Marshal, a company is a person, artificial, invisible, intangible and existing only in the eyes of law. Being a mere creation of law, it possesses only those properties which the charter of its creation confers upon it, either expressly or as incidental to its very existence. A company usually raises its capital in the form of shares called share capital, and debentures debt capital. This chapter deals with the accounting for share capital of companies. Features of a company. A company may be viewed as an association of persons who contribute money or money's worth to a common inventory and use it for a common purpose. It is an artificial person having corporate legal entity distinct from its members shareholders, and has a common seal used for its signature. It has certain special features which distinguish it from the other forms of organization. These are as follows. Body corporate. A company is formed according to the provisions of law enforced from time to time. Generally, in India, the companies are formed and registered under companies law except in the case of banking and insurance companies, for which a separate law is provided for. Separate legal entity. A company has a separate legal entity which is distinct and separate from its members. It can hold and deal with any type of property. It can enter into contracts and even open a bank account in its own name. Limited liability. The liability of the members of the company is limited to the extent of unpaid amount of the shares held by them. In the case of the companies limited by guarantee, the liability of its members is limited to the extent of the guarantee given by them. In the event of the company being wound up, perpetual succession, the company being an artificial person created by law continues to exist irrespective of the changes in its membership. A company can be terminated only through law. The death or insanity or insolvency of any member of the company in no way affects the existence of the company. Members may come and go, but the company continues. Common seal. The company being an artificial person cannot sign its name by itself. Therefore, every company is required to have its own seal which acts as official signatures of the company. Any document which does not carry the common seal of the company is not binding on the company. Transferability of shares. The shares of a public, limited company are freely transferable. The permission of the company or the consent of any member of the company is not necessary for the transfer of shares, but the articles of the company can prescribe the manner in which the transfer of shares will be made. May sue or be sued. A company being a legal person can enter into contracts and can enforce the contractual rights against others. It can sue and be sued in its name if there is a breach of contract by the company. 1.2 Kinds of companies. Companies can be classified either on the basis of the liability of its members, or on the basis of the number of members. On the basis of liability of its members, the companies can be classified into the following three categories. I. Companies limited by shares. In this case, the liability of its members is limited to the extent of the nominal value of shares held by them. If a member has paid the full amount of the shares, there is no liability on his part whatsoever may be for the debts of the company. He need not pay a single paise from his private property. Can be enforced during the existence of the company as well as during the winding up. 2. Companies limited by guarantee. In this case, the liability of its members is limited to the amount they undertake to contribute in the event of the company being wound up. Thus, the liability of the members will arise only in the event of its winding up. 3. Unlimited companies. When there is no limit on the liability of its members, the company is called an unlimited company. When the company's property is not sufficient to pay off its debts, the private property of its members can be used for the purpose. In other words, the creditors can claim their dues from its members. Such companies are not found in India, even though permitted by the Companies Act. On the basis of the number of members, companies can be divided into 3 categories as follows. I. Public company. A public company means a company which is not a private company, is a company which is not a subsidiary of a private company. 2. Private company. A private company is one which by its articles of association restricts the right to transfer its shares. A private company must have at least 2 persons, except in case of 1-person company. C. Limits the number of its members to 200 excluding its employees. 3. 1-person company. Op. Sec. 262 of the Companies Act 2013 defines OP as a company which has only 1 person as a member. Rule 3 of the Companies Incorporation Rules 2014 provides that only a natural person being an Indian citizen and resident in India can form 1-person company. It cannot carry out non-banking financial investment activities. C. Its paid-up share capital is not more than Rs. 50 lakhs. Its average annual turnover of 3 years does not exceed Rs. 2 crores. 1.3 Share capital of a company. A company, being an artificial person, cannot generate its own capital which has necessarily to be collected from several persons. These persons are known as shareholders and the amount contributed by them is called share capital. Since the number of shareholders is very large, a separate capital account cannot be opened for each one of them. Hence, innumerable streams of capital contribution merge their identities in a common capital account called as share capital account. 2021 Categories of share capital. From accounting point of view, the share capital of the company can be classified as follows. Authorized capital. Authorized capital is the amount of share capital which a company is authorized to issue by its memorandum of association. The company cannot raise more than the amount of capital as specified in the memorandum of association. It is also called nominal or registered capital. The authorized capital can be increased or decreased as per the procedure laid down in the Companies Act. It should be noted that the company need not issue the entire authorized capital for public subscription at a time. Depending upon its requirement, it may issue share capital, but in any case, it should not be more than the amount of authorized capital. Issued capital. It is that part of the authorized capital which is actually issued to the public for subscription, including the shares allotted to vendors and the signatories to the company's memorandum. The authorized capital, which is not offered for public subscription, is known as unissued capital. Unissued capital may be offered for public subscription at a later date. Subscribed capital. It is that part of the issued capital which has been actually subscribed by the public. When the shares offered for public subscription are subscribed fully by the public, the issued capital and subscribed capital would be the same. It may be noted that ultimately, the subscribed capital may be equal to or less than issued capital. In case the number of shares subscribed is less than what is offered, the company allots only the number of shares for which subscription has been received. In case it is higher than what is offered, the allotment will be equal to the offer. In other words, the fact of oversubscription is not reflected in the books called up capital. It is that part of the subscribed capital which has been called up on the shares, i.e., what the company has asked the shareholders to pay. The company may decide to call the entire amount or part of the face value of the shares. For example, if the face value, also called nominal value, of a share allotted is Rs. 10 and the company has called up only Rs. 7 per share, in that scenario, the called up capital is Rs. 7 per share. The remaining Rs. third may be collected from its shareholders as and when needed. Paid up capital. It is that portion of the called up capital which has been actually received from the shareholders. When the shareholders have paid all the called amount, the called up capital is the same to the paid up capital. If any of the shareholders has not paid amount on calls, such an amount may be called as calls in arrears. Therefore, paid up capital is equal to the called up capital minus call in arrears. Uncalled capital, that portion of the subscribed capital which has not yet been called up. As stated earlier, the company may collect this amount any time when it needs further funds. Reserve capital. A company may reserve a portion of its uncalled capital to be called only in the event of winding up of the company. Such uncalled amount is called reserve capital of the company. It is available only for the creditors on winding up of the company. Authorized share capital. Issued capital, unissued capital, subscribed and fully paid up. Subscribed but not fully paid up. Exhibit 1.1 Categories of share capital. Let us take the following example and show how the share capital will be shown in the balance sheet. Sunrise Company Ltd, New Delhi, has registered its capital as Rs 40,000,000 divided into 4,000,000 shares of Rs 10 each. The company offered to the public for subscription of 2,000,000 shares of Rs 10 each, to be received as Rs 2 on application, Rs 0.3 on allotment, Rs 0.3 on first call and the balance on final call. The company received applications for 250,000 shares. The company finalized the allotment of 2,000,000 shares and rejected applications for 50,000 shares. The company did not make the final call. The company received all the amount except on 2,000 shares where call money has not been received. The above amounts will be shown in the notes to accounts of the balance sheet of Sunrise Company Ltd. as follows. Notes to accounts. Share capital Rs. Authorized or registered or nominal capital 4,000,000 shares of Rs 10 each 40,000,000. Issued capital 2,000,000 shares of Rs 10 each 20,000,000. Subscribed capital. Subscribed but not fully paid up 2,000,000 shares of Rs 10 each. Rs 8 called up 16,000,000 less. Calls in arrears 6,015 94,000. Nature and classes of shares. Shares refer to the units into which the total share capital of a company is divided. Thus, a share is a fractional part of the share capital and forms the basis of ownership interest in a company. The persons who contribute money through shares are called shareholders. The amount of authorized capital, together with the number of shares in which it is divided, is stated in the Memorandum of Association, but the classes of shares in which the company's capital is to be divided, along with their respective rights and obligations, are prescribed by the Articles of Association of the company. As per the Companies Act, a company can issue two types of shares: 1. Preference shares, and 2. Equity shares, also called ordinary shares. 1.4.1 Preference shares. According to Section 43 of the Companies Act, 2013, a preference share is one which fulfills the following conditions: a. That it carries a preferential right to dividend to be paid either as a fixed amount payable to preference shareholders or an amount calculated by a fixed rate of the nominal value of each share before any dividend is paid to the equity shareholders; that with respect to capital it carries or will carry, on the winding up of the company, the preferential right to the repayment of capital before anything is paid to equity shareholders. However, notwithstanding the above two conditions, a holder of the preference share may have a right to participate fully or to a limited extent in the surpluses of the company as specified in the memorandum or articles of the company. Thus, the preference shares can be participating and non-participating. Similarly, these shares can be cumulative or non-cumulative, and redeemable or irredeemable. 1.4.2 Equity shares. According to Section 43 of the Companies Act, 2013, An equity share is a share which is not a preference share. In other words, shares which do not enjoy any preferential right in the payment of dividend or repayment of capital are termed as equity/ordinary shares. The equity shareholders are entitled to share the distributable profits of the company after satisfying the dividend rights of the preference shareholders. The dividend on equity shares is not fixed and it may vary from year to year depending upon the amount of profits available for distribution. The equity share capital may be I, with voting rights, or II, with differential rights as to voting, dividend or otherwise in accordance with such rules and subject to such conditions as may be prescribed in the Articles of Association of the company. Issue of shares. A salient characteristic of the capital of a company is that the amount on its shares can be gradually collected in easy installments spread over a period of time depending upon its growing financial requirement. The first installment is collected along with application, and is thus known as application money. The second on allotment termed as allotment money, and the remaining installments are termed as first call, second call, and so on. The word final is suffixed to the last installment. However, this in no way which prevents a company from calling the full amount on shares right at the time of application. The important steps in the procedure of share issue are: issue of prospectus. The company first issues the prospectus to the public. Prospectus is an invitation to the public that a new company has come into existence and it needs funds for doing business. It contains complete information about the company and the manner in which the money is to be collected from the prospective investors. Receipt of applications. When prospectus is issued to the public, prospective investors intending to subscribe the share capital of the company would make an application along with the application money and deposit the same with a scheduled bank as specified in the prospectus. The company has to get minimum subscription within 120 days from the date of the issue of the prospectus. If the company fails to receive the same within the said period, the company cannot proceed for the allotment of shares and application money should be returned within 130 days of the date of issue of prospectus. Allotment of shares. If minimum subscription has been received, the company may proceed for the allotment of shares after fulfilling certain other legal formalities. Letters of allotment are sent to those whom the shares have been allotted, and letters of regret to those to whom no allotment has been made. When allotment is made, it results in a valid contract between the company and the applicants who now became the shareholders of the company. Minimum subscription. The minimum amount that, in the opinion of directors, must be raised to meet the needs of business operations of the company relating to the price of any property purchased or to be purchased, which has to be met wholly or partly out of the proceeds of issue, preliminary expenses payable by the company, and any commission payable in connection with the issue of shares, the repayment of any money borrowed by the company for the above two matters, working capital, and any other expenditure required for the usual conduct of business operations. It is to be noted that minimum subscription of capital cannot be less than 90% of the issued amount according to SEBI Disclosure and Investor Protection Guidelines 2006.3.8.1 and 6.3.8.2. If this condition is not satisfied, the company shall forthwith refund the entire subscription amount received. If a delay occurs beyond 8 days from the date of closure of subscription list, the company shall be liable to pay the amount with interest at the rate of 15%. Section 73(2). Shares of a company are issued either at par or at a premium. Shares are to be issued at par when their issue price is exactly equal to their nominal value, according to the terms and conditions of issue. When the shares of a company are issued more than its nominal value face value, the excess amount is called premium, irrespective of the fact that shares are issued at par or at a premium. The share capital of a company, as stated earlier, may be collected in installments, payable at different stages. 1.6 Accounting treatment. On application, the amount of money paid with various installment represents the contribution to share capital and should ultimately be credited to share capital. However, for the sake of convenience, initially individual accounts are opened for each installment. All money received along with application is deposited with a scheduled bank in a separate account opened for the purpose. The journal entry is as follows: bank/C drive to share application/C amount received on application for shares at Rs per share on allotment when minimum subscription has been received and certain legal formalities on the allotment of shares have been duly compiled with. The directors of the company proceed to make the allotment of shares. The allotment of shares implies a contract between the company and the applicants who now become the allottees and assume the status of shareholders or members. Allotment of shares. Implications from accounting point of view. It is customary to ask for some amount, called allotment money, from the allottees on the shares allotted to them as soon as the allotment is made, with the acceptance to the offer made by the applicants. The amount of application money received has to be transferred to share capital account, as it has formally become the part of the same. The money received on rejected applications should be fully returned to the applicant within period prescribed by law/SEBI. In case lesser number of shares have to be allotted than those applied for, the excess application money must be adjusted towards the amount due on allotment from the allottees. The effect of the later two steps is to close the share application account, which is only a temporary account for share capital transactions. The journal entries with regard to allotment of shares are as follows: 1. For transfer of application money, share application/C drive to share capital A/C application money on shares allotted / transferred to share capital. 2. For money refunded on rejected application, share application/C drive to bank A/C application money returned on rejected application for shares. 3. For amount due on allotment, share allotment/C drive to share capital A/C. 4. For adjustment of excess application money, share application/C drive to share allotment/C application money on shares at Rs per shares, adjusted to the amount due on allotment. 5. For receipt of allotment money, bank/C drive to share allotment/C allotment money received on shares at Rs per share combined account. Note minus the journal entries 2 and 4 can also be combined as follows: share application/C to share allotment/C to bank/C excess application money adjusted to share allotment and balance refunded. Sometimes a combined account for share application and share allotment, called share application and allotment account, is opened in the books of a company. The combined account is based on the reasoning that allotment without application is impossible, while application without allotment is meaningless. These two stages of share capital are closely interrelated. When a combined account is maintained, journal entries are recorded in the following manner: for receipt of application and allotment, bank/C drive to share application and allotment/C money received on applications for shares at Rs per share. 2. For transfer of application money and allotment amount due, share application and allotment/C drive to share capital A/C transfer of application money to share capital account for amount due or allotment of share at Rs per share. 3. For money refunded on rejected applications, share application and allotment/C drive to bank/C application money returned on rejected application for shares. 4. On receipt of allotment amount, bank/C drive to share application and allotment/C balance of allotment money received. Applications supported by blocked amount ASBA initial public offers and rights issues EC. of securities, shares, debentures or other financial instruments may be subscribed by paying application money by a banking instrument, check, pay order/draft, debit to bank account or through applications. Supported blocked amount ASBA. ASBA is one of the methods for payment of application money. ASBA is a process developed by Securities and Exchange Board of India (SEBI) to apply for subscribing to IPOs and rights issue of securities. Under the method, the applicant authorizes the bank to block the bank account for the application money. For subscribing the issue, the bank debits the applicant's account with application money only if he/she is allotted securities, shares/debentures, etc. 4. The amount payable on allotted securities. In case securities are not allotted, the bank removes the block lien on the amount. Under ASBA-based applications, application amount payable on the securities applied is blocked by the bank, i.e., it marks a lien on amount payable as application money on securities applied. After the company has allotted securities, bank debits the applicant's bank account by the amount payable on allotted securities and remove the lien on the balance amount. On calls play a vital role in making shares fully paid up and for realizing the full amount of shares from the shareholders. In the event of shares not being fully called up till the completion of allotment, the directors have the authority to ask for the remaining amount on shares as and when they decide about the same. It is also possible that the timing of the payment of calls by the shareholders is determined at the time of share issue itself and given in the prospectus. 2 points are important regarding the calls on shares. First, the amount on any call should not exceed 25% of the face value of shares. Second, there must be an interval of at least 1 month between the making of 2 calls unless otherwise provided by the Articles of Association of the company. When a call is made and the amount of the same is received, the journal entries are as given below. 1. For call amount due, share call A/C drive to share capital A/C. Call money due on underbar shares at Rs underbar per share. 2. For receipt of call amount, bank A/C drive to share call A/C. Call money received. The words first, second, or third must be added between the words share and call in the share call account depending upon the identity of the call made. For example, in case of first call it will be termed as share first call account. In case of second call, it will be share second call account, and so on. Another point to be noted is that the words and final will also be added to the last call. Say, if second call is the last call, it will be termed as second and final call, and if it is the third call which is the last call, it will be termed as third and final call. It is also possible that the whole balance after allotment may be collected in one call only. In that case, the first call itself shall be termed as the first and final call. The following points should be kept in mind while issuing the share capital for public subscription. 1. The application money should be at least 5% of the face value of the share. 2. Calls are to be made as per the provisions of the Articles of Association. 3. Where there is no Articles of Association of its own, the following provisions of Table A will apply. A period of 1 month must elapse between 2 calls. The amount of call should not exceed 25% of the face value of the share. C. A minimum of 14 days notice is given to the shareholders to pay the amount, and calls must be made on a uniform basis on all shares within the same class. 4. The procedure for accounting for the issue of both equity and preference shares is the same. To differentiate between the two, the words equity and preference is prefixed to each and every installment. Illustration 1. Mona Earth Mover Limited decided to issue 12,000 shares of Rs.100 each, payable at Rs.30 on application, Rs.40 on allotment, Rs.20 on first call, and balance on second and final call. Applications were received for 13,000 shares. The directors decided to reject application of 1,000 shares, and their application money being refunded in full. The allotment money was duly received on all the shares, and all sums due on calls are received except on 100 shares. Record the transactions in the Books of Mona Earth Movers Limited. Solution: Books of Mona Earth Mover Limited. Journal: Date particulars LF. Debit credit. Amount RS banker/C drive 390,000 to share application A/C 390,000 application money on 13,000 shares at RS.30 per share received. Share application A/C drive 360,000 to share capital A/C 360,000 application money transferred to share capital. Share application A/C drive 30,000 to bank A/C 30,000 application money on 1,000 shares returned. Share allotment A/C drive 480,000 to share capital A/C 480,000 money due on allotment of 12,000 shares at RS 40 per share. Bank A/C drive 480,000 to share allotment A/C 480,000 money received on 12,000 shares at RS 40 per share on allotment. Share first call A/C drive 240,000 to share capital A/C 240,000 money due on 12,000 shares at RS 20 per share on first call. Bank A/C drive 238,000 to share first call A/C 238,000 first call money received except for 100 shares. Share second and final call A/C drive 120,000 to share capital A/C 120,000 money due on 12,000 shares at RS 10 per share on second and final call. Bank A/C drive 119,000 to share second and final call A/C 119,000 second and final call money received except for 100 shares. Illustration 2. Eastern Company Limited issued 40,000 shares of RS 10 each to the public for the subscription out of its share capital, payable as RS 4 on application, RS 3 on allotment, and the balance on ist and final call. Applications were received for 40,000 shares. The company made the allotment to the applicants in full. All the amounts due on allotment and first and final call were duly received. Give the journal entries in the books of the company. Solution: Books of Eastern Company Limited. Journal: Date particulars LF. Debit credit. Amount RS bank A/C drive 160,000 to share application A/C 160,000 application money on 40,000 shares at RS.4 per share received. 5. Share application A/C drive 160,000 to share capital A/C 160,000 application money transferred to share capital. Share allotment A/C drive 120,000 to share capital A/C 120,000 money due on allotment of 40,000 shares at RS 3 per share. Bank A/C drive 120,000 to share allotment A/C 120,000 money received on 40,000 shares at RS 3 per share on allotment. Share first and final call A/C drive 120,000 to share capital A/C 120,000 money due on 40,000 shares at RS 3 per share on first and final call. Bank A/C drive 120,000 to share first and final call A/C 120,000 first and final call money received. Do it yourself. 1. On April 1, 2019, a limited company was incorporated with an authorized capital of Rs 40,000 divided into shares of Rs 10 each. It offered to the public for subscription of 3,000 shares payable as follows: on application Rs 3 per share, on allotment Rs 2 per share, on first call 1 month after allotment Rs 2.50 per share, on second and final call Rs 2.50 per share. The shares were fully subscribed for by the public and application money duly received on April 15, 2019. The directors made the allotment on May 1, 2015. How will you record the share capital transactions in the books of a company if the amounts due have been duly received, and the company maintains the combined account for application and allotment? 2. Harsha Ltd. was registered with authorized capital of Rs 25,000,000 divided into 250,000 equity shares of Rs 10 each. Promoters of the company had undertaken to subscribe 25,000 equity shares of Rs 10 each once the company was incorporated. The amount was paid by the subscribers and received by the company. The company later issued at par 200,000 shares to public for subscription. It received applications for 180,000 equity shares both through ASBA and physical mode. Shares were allotted to all the applicants. Determine the authorized share capital, issued share capital and subscribed share capital of the Harsha Ltd. Calls in arrears. It may happen that shareholders do not pay the call amount on due date. When any shareholder fails to pay the amount due on allotment or on any of the calls, such amount is known as calls in arrears/unpaid calls. Calls in arrears represent the debit balance of all the calls account. Such amount shall appear as note to accounts refer Chapter 3. However, where a company maintains calls in arrears account, it needs to pass the following additional journal entry: calls in arrears /C drive, to share first call account /C, to share second and final call account /C, calls in arrears brought into account. The articles of association of a company may empower the directors to charge interest at a stipulated rate on calls in arrears. If the articles are silent in this regard, the rule contained in Table F shall be applicable, which states that the interest at a rate not exceeding 10% PA shall have to be paid on all unpaid amounts on shares for the period intervening between the date fixed for payment and the time of actual payment thereof. On receipt of the call amount together with interest, the amount of interest shall be credited to interest account, while call money shall be credited to the respective call account or to calls in arrears account. When the shareholder makes the payment of calls in arrears together with interest, the entry will be as follows: bank /C drive, to calls in arrears /C, to interest on calls in arrears /C, calls in arrears received with interest. Note, if nothing is specified, there is no need to take the interest on calls in arrears account and record the above entry. Illustration 3. Chronic Limited issued 10,000 equity shares of Rs 10 each payable at Rs 2.50 on application, Rs 3 on allotment, Rs 2 on first call, and the balance of Rs 2.50 on second and final call. All the shares were fully subscribed and paid except of a shareholder having 100 shares who could not pay for second and final call. Give journal entries to record these transactions. Solution: Books of Chronic Limited. Journal. Date particulars LF. Debit credit. Amount Rs. Bank /C drive 25,000 to equity share application /C 25,000. Money received on applications for 10,000 shares at Rs 2.50 per share. Equity share application /C drive 25,000 to equity share capital /C 25,000. Transfer of application money on 10,000 shares to share capital. Equity share allotment /C drive 30,000 to equity share capital /C 30,000. Amount due on the allotment of 10,000 shares at Rs 3 per share. Bank /C drive 30,000 to equity share allotment /C 30,000. Allotment money received. Share first call /C drive 20,000 to equity share capital /C 20,000. First call money due on 10,000 shares at Rs 2 per share. Bank /C drive 20,000 to equity share first call /C 20,000. First call money received. Share second and final call /C drive 25,000 to equity share capital /C 25,000. Final call money due. Bank /C drive 24,750. Call in arrears /C drive 250 to equity share second and final call /C C 25,000. Final call money received, except that of 100 shares. 2021 to 22. Calls in advance. Sometimes shareholders pay a part or the whole of the amount of the calls not yet made. The amount so received from the shareholders is known as calls in advance. The amount received in advance is a liability of the company and should be credited to call in advance account. The amount received will be adjusted towards the payment of calls as and when they becomes due. Table F of the Companies Act provides for the payment of interest on calls in advance at a rate not exceeding 12% per annum. The following journal entry is recorded for the amount of calls received in advance. Bank/C drive to calls in advance/C. Amount received on call in advance. On the due date of the calls, the amount of calls in advance is adjusted by the following entry: calls in advance/C drive to particular call/C. Calls in advance adjusted with the call money due. The balance in calls in advance account is shown as a separate item under the title Equity and Liabilities in the company's balance sheet under the head Current Liabilities. As subhead Others Current Liabilities, it is not added to the amount of paid-up capital. As calls in advance is a liability of the company, it is under obligation, if provided by the articles, to pay interest on such amount from the date of its receipt up to the date when appropriate call is due for payment. A stipulation is generally made in the articles regarding the rate at which interest is payable. However, if articles are silent on this account, Table F is applicable, which provides for interest on calls in advance at a rate not exceeding 12% per annum. The accounting treatment of interest on calls in advance is as follows. 1. For payment of interest on calls in advance/C drive to bank/C, interest paid on calls in advance, or 2. For interest due, interest on calls in advance/C drive to sundry shareholders/C, interest paid on calls in advance. 2. For interest paid, sundry shareholders/C drive to bank/C. 2. Illustration 4. Conacher Limited registered with an authorized equity capital of Rs 200,000 divided into 2,000 shares of Rs 100 each, issued for subscription of 1,000 shares payable at Rs 25 per share on application, Rs 30 per share on allotment, Rs 20 per share on first call, and the balance as and when required. Application money on 1,000 shares was duly received, and allotment was made to them. The allotment amount was received in full, but when the first call was made, one shareholder failed to pay the amount on 100 shares held by him, and another shareholder with 50 shares paid the entire amount on his shares. The company did not make any other call. Give the necessary journal entries in the books of the company to record these share capital transactions. Solution: Books of Conacher Limited. Journal. Date particulars LF. Debit credit. Amount Rs. Bank/C drive 25,000 to equity share application/C 25,000. Money received on application for 1,000 shares at Rs 25 per share. Equity share application/C drive 25,000 to equity share capital/C 25,000. Transfer of application money on 1,000 shares to share capital. Equity share allotment/C drive 30,000 to equity share capital/C 30,000. Amount due on the allotment of 1,000 shares at Rs 30 per share. Bank/C drive 30,000 to equity share allotment/C 30,000. Allotment money received. Equity share first call/C drive 20,000 to equity share capital/C 20,000. First call money due on 1,000 shares at Rs 20 per share. Bank/C drive 19,250. Calls in arrears/C drive 2,000 to equity share first call/C 20,000. 25,000 to calls in advance C 1,250. First call money received on 900 shares. Calls in arrears for 100 shares at Rs. 0.20 per share and calls in advance for 50 shares at Rs. 0.25 per share. In practice, the entries for the amount received are recorded in the cash book and not in the journal. See Illustration 5. Illustration 5. Unique Pictures Limited was registered with an authorized capital of Rs. 500,000 divided into 20,000 5% preference shares of Rs. 10 each and 30,000 equity shares of Rs. 10 each. The company issued 10,000 preference and 15,000 equity shares for public subscription. Calls on shares were made as under equity shares, preference shares, Rs. Application 2.2. Allotment 3.3. First call 2.50. Second and final call 2.50. All these shares were fully subscribed. All the dues were received except the second and final call on 100 equity shares and on 200 preference shares. Record these transactions in the journal. You are also required to prepare the cash book and balance sheet. Solution. Books of Unique Pictures Limited. Journal. Date particulars LF. Debit credit. Amount Rs. Equity share application A/C drive 30,000. 5% preference share application A/C drive 20,000. To equity share capital A/C 30,000. To 5% preference share capital A/C 20,000. Transfer of application money. Equity share allotment A/C drive 45,000. 5% preference share allotment A/C drive 30,000. To equity share capital A/C 45,000. To 5% preference share capital A/C 30,000. Amount due on allotment. Equity share first call A/C drive 37,500. 5% preference share first call A/C drive 25,000. To equity share capital A/C 37,500. To 5% preference share capital A/C 25,000. First call money due. Equity share second and final call A/C drive 37,500. 5% preference share second and final call A/CDR 25,000. To equity share capital A/C 37,500. To 5% preference share capital A/C 25,000. First call money due. Call in arrears A/C drive 750. To equity share second and final call A/C 250. To 5% preference share final call A/C 500. For calls in arrears. Oversubscription. There are instances when applications for more shares of a company are received than the number offered to the public for subscription. This usually happens in respect of shares issue of well-managed and financially strong companies and is said to be a case of oversubscription. In such a condition, three alternatives are available to the directors to deal with the situation. 1. They can accept some applications in full and totally reject the others. 2. They can make a pro rata allotment to all. And 3. They can adopt a combination of the above two alternatives, which happens to be the most common course adopted in practice. The problem of oversubscription is resolved with the allotment of shares. Therefore, from the accounting point of view, it is better to place the situation of oversubscription within the total frame of application and allotment, i.e., receipt of application amount due on allotment and its receipt from the shareholders, and the same has been observed in the pattern of entries. First alternative, when the directors decide to fully accept some applications and totally reject the others, the application money received on rejected applications is fully refunded. For example, a company invited applications for 20,000 shares and received the applications for 25,000 shares. The directors rejected the applications for 5,000 shares shares, which are in excess of the required number, and refunded their application money in full. In this case, the journal entries on application and allotment will be as follows. The journal entries on application and allotment according to this alternative are as follows. 1. Bank A/C drive to share application A/C. Money received on application for 25,000 shares at Rs under bar per share. 2. Share application A/C drive to share capital A/C to bank A/C. Transfer of application for money 20,000 for shares allotted and money refunded on applications for 5,000 shares rejected. 3. Share allotment A/C drive to share capital A/C. Amount due on the allotment of 20,000 shares at Rs under bar per share. 4. Bank A/C drive to share allotment A/C. Allotment money received 2021 to 22. Second alternative, when the directors opt to make a proportionate allotment to all applicants called pro rata allotment, the excess application money received is normally adjusted towards the amount due on allotment. In case the excess application money received is more than the amount due on allotment of shares, such excess amount may either be refunded or credited to calls in advance. For example, in the event of applications for 20,000 shares being invited, and those received are for 25,000 shares, it is decided to allot shares in the ratio of 4:5 to all applicants. It is a case of pro rata allotment, and the excess application money received on 5,000 shares would be adjusted towards the amount due on the allotment of 20,000 shares. In this case, the journal entries on application and allotment will be as follows. 1. Bank A/C drive to share application A/C. Application money received on 25,000 shares at Rs under bar per share. 2. Share application A/C drive to share capital A/C to share allotment A/C. Transfer of application money to share capital and the excess application money on 5,000 shares credited to share allotment account. 3. Share allotment A/C drive to share capital A/C. Amount due on allotment of 25,000 share at Rs under bar per share. 4. Bank A/C drive to share allotment A/C. Allotment money received after adjusting the amount already received as excess application money. Third alternative, when the application for some shares are rejected outrightly and pro rata allotment is made to the remaining applicants, the money on rejected applications is refunded and the excess application money received from applicants to whom pro rata allotment has been made is adjusted towards the amount due on the allotment of shares allotted. For example, a company invited applications for 10,000 shares and received applications for 15,000 shares. The directors decided to reject the applications for 2,500 shares outright and to make a pro rata allotment of 10,000 shares to the applicants for the remaining 12,500 shares, so that 4 shares are allotted for every 5 shares applied. In this case, the money on applications for 2,500 shares rejected would be refunded fully, and that on the remaining 2,500 shares, 12,500 shares, 10,000 shares, would be adjusted against the allotment amount due on 10,000 shares allotted and credited to share allotment account. The journal entries on application and allotment recorded as follows. 1. Bank A/C drive to share application A/C. Money received on application for 15,000 shares at Rs under bar per share. 2. Share application A/C drive to share capital A/C to share allotment A/C to bank A/C. Transfer of application money to share capital and the excess application amount of pro rata allottees credited to share allotment and the amount on rejected applications refunded. 3. Share allotment A/C drive to share capital A/C. Amount due on the allotment of 10,000 shares at Rs under bar per share. 4 bank A/C drive. To share allotment A/C. Allotment money received after adjusting the amount already received as excess. Application money. Illustration 7. Hunter Papers Limited invited applications for 100,000 equity shares of Rs. 25, each payable as under. On application Rs. 5.00 per share. On allotment Rs. 7.50 per share. On first call Rs. 7.50 per share, due 2 months after allotment. On second and final call Rs. 5.00 per share, due 2 months after first call. Applications were received for 400,000 shares on January 1, 2017 and allotment was made on February 1, 2017. Record journal entries in the books of the company to record these share capital transactions under each of the following circumstances. The directors decide to allot 100,000 shares in full to selected applicants, and the applications for the remaining 300,000 shares were rejected outright. 2. The directors decide to make a pro rata allotment of 25% of the shares applied for to every applicant, to apply the balance of application money towards amount due on allotment, and to refund the amount remaining thereafter. 3. The directors totally reject applications for 200,000 shares, accept full applications for 80,000 shares and make a pro rata allotment of the 20,000 shares to remaining applicants, and the excess application money is to be adjusted towards allotment and calls to be made. Solution. Books of Hunter Papers Limited. Journal. First alternative. Date particulars LF. Debit credit. Amount Rs. 2017, January 1st bank A/C drive, 20,000,000 to equity share application A/C 20,000,000, money received on applications for 400,000 shares at Rs. 5 per share, February 1st equity share application A/C drive, 20,000,000 to equity share capital A/C 500,000 to bank A/C 15,000,000, transfer of application money on 100,000 shares to share capital and money refunded on rejected applications. February 1st equity share allotment A/C drive, 750,000 to equity share capital A/C 750,000, amount due on the allotment of 100,000 shares at Rs. 7.50 per share, bank A/C drive, 750,000 to equity share allotment A/C 750,000, allotment money received, April 1st equity share first call A/C drive, 750,000 to equity share capital A/C 750,000, first call money due on 100,000 shares at Rs. 7.50 per share, April 1st bank A/C drive, 750,000 to equity share first call A/C 750,000, first call money received, June 1st equity share second and final call A/C drive, 500,000 to equity share capital A/C 500,000, final call money due on 100,000 shares at Rs. 5 per share, June 1st bank A/C drive, 500,000 to equity share second and final call A/C 500,000, final call money received, second alternative, date particulars LF, debit credit, amount Rs. 2017, January 1st bank A/C drive, 20,000 to equity share application A/C 20,000, money received on applications for 400,000 shares at Rs. 5 per share. February 1st equity share application /C drive 20,000,000 to equity share capital /C 5,000,000 to equity share allotment /C 750,000 to bank /C 750,000 transfer of application money on shares allotted to share capital excess application amount credited to allotment account and money refunded on rejected applications. February 1st equity share allotment /C drive 750,000 to equity share capital /C 750,000 amount due on the allotment of Rs 1,000,000 shares at Rs 7.50 per share. Note: the entries regarding the two calls would be the same as given in preceding method. Third alternative: date particulars LF debit credit amount Rs 2017 January 1st bank /C drive 20,000,000 to equity share application /C 20,000,000 money received on applications for 4,000,000 shares at Rs 5 per share. February 1st equity share application /C drive 20,000,000 to equity share capital /C 5,000,000 to equity share allotment /C 150,000 to calls in advance /C 250,000 to bank /C 11,000,000 amount on share application adjusted to share capital, share allotment and calls in advance and the balance refunded including the money on rejected applications. February 1st equity share allotment /C drive 750,000 to equity share capital /C 750,000 transfer of application money on shares allotted to share capital and amount due on the allotment of 1,000,000 shares at Rs 7.50 per share. Bank /C drive 6,000,000 to equity share allotment /C 6,000,000 allotment money received April 1st equity share first call /C drive 750,000 to equity share capital /C 750,000 first call money due on 1,000,000 shares at Rs 7.50 per share. April 1st bank /C drive 6,000,000 calls in advance /C drive 150,000 to equity share first call /C 750,000 calls in advance adjusted against first call and the balance money on call received June 1st equity share second and final call /C drive 5,000,000 to equity share capital /C 5,000,000 final call money due on 1,000,000 shares at Rs 5 per share. June 1st bank /C drive 4,000,000 calls in advance /C drive 1,000,000 to equity share second and final call /C 5,000,000 calls in advance adjusted against final call and the balance money on call received. Note: the balance of excess application money as a result of pro rata distribution in journal entry 3 above is large enough to meet the demands on allotted shares in respect of the allotment and the to call money, as well as to leave an amount to be refunded along with that on the rejected applications. Working notes: Rs excess application money 15,000,000 less transfers share allotment 20,000 shares at Rs 7.50 150,000 share calls 20,000 shares at Rs 12.50 250,000 4,000,001 amount to be refunded including that on 11,000,000 the rejected applications. 1.6.4 Undersubscription. Undersubscription is a situation where number of shares applied for is less than the number for which applications have been invited for subscription. For example, a company offered 2 lakh shares for subscription to the public, but the applications were received for 190,000 shares only. In such a situation, the allotment will be confirmed to 190,000 shares and entries shall be made accordingly. However, as stated earlier, it must be ensured that the company has received the minimum subscriptions and the company will have to refund the entire subscription amount received. 1.6.5 Issue of shares at a premium. It is quite common for the shares of financially strong and well-managed companies to be issued at a premium, i.e., at an amount more than the nominal or par value of shares. Thus, when a share of the nominal value of Rs. 100 is issued at Rs. 105, it is said to have been issued at a premium of 5%. When the issue of shares is at a premium, the amount of premium may technically be called at any stage of the issue of shares. However, premium is generally called with the amount due on allotment, sometimes with the application money and rarely with the call money. The premium amount is credited to a separate account called securities premium account and is shown under the title Equity and Liabilities of the company's balance sheet. Under the head Reserves and Surpluses, it can be used only for the following 5 purposes: a. To issue fully paid bonus shares to the extent not exceeding unused share capital of the company. To write off preliminary expenses of the company. C. To write off the expenses of, or commission paid, or discount allowed, on any securities of the company, and to pay premium on the redemption of preference shares or debentures of the company. E. Purchase of its own shares, i.e., buyback of shares. The journal entries for shares issued at a premium are as follows. 1. For premium amount called with application money, a bank /C drive. To share application /C. Money received on application for shares at Rs. per share including premium. Share application /C drive. To share capital /C. To securities premium reserve /C. Transfer of application money to share capital and securities premium account. 2. Premium amount called with allotment money, a share allotment /C drive. To share capital /C. To securities premium reserve /C. Amount due on allotment of shares at Rs per share including premium. Bank /C drive. To share allotment /C. Allotment money received including premium. 3. Premium amount called with call money, a share application /C. To share capital reserve /C. To securities premium /C. Amount due on is/2 nd call at Rs per share including premium. Bank /C drive. To share call /C. Call money received including premium. Illustration 8. Jupiter Company Limited issued 35,000 equity shares of Rs. 10 each at a premium of Rs. 0.2 payable as follows. On application Rs. 3. On allotment Rs. 5 including premium. Balanced on first and final call. The issue was fully subscribed. All the money was duly received. Record journal entries in the books of the company. Solution. Books of Jupiter Company Limited. Journal. Date particulars LF. Debit credit. Amount Rs. Bank /C drive 105000 to equity share application /C 105000 money received on applications for 35,000 shares at Rs 3 per share equity share application /C drive 105000 to equity share capital /C 105000 transfer of application money on allotment to share capital equity share allotment /C drive 175,000 to equity share capital /C 105000 to securities premium reserve /C 70,000 amount due on allotment of 35,000 shares at Rs 5 per share including premium. Bank /C drive 175,000 to equity share allotment /C 175,000 money received including premium. Equity share first and final call /C drive 140,000 to equity share capital /C 140,000 amount due on first and final call of Rs 4 per share on 35,000 shares. Bank/C drive 140,000 to equity share first and final call/C 140,000 money received on first and final call. Issue of shares at a discount. There are instances when the shares of a company are issued at a discount, i.e., at an amount less than the nominal or par value of shares. The difference between the nominal value and issue price representing discount on the issue of shares. For example, when a share of the nominal value of Rs 100 is issued at Rs 98, it is said to have been issued at a discount of 2%. As a general rule, a company cannot ordinarily issue shares at a discount. It can do so only in cases such as reissue of forfeited shares to be discussed later, and issue of sweat equity shares. 1.6.7 Issue of shares for consideration other than cash. There are instances where a company enters into an arrangement with the vendors from whom it has purchased assets, whereby the latter agrees to accept the payment in the form of fully paid shares of the company issued to them. Normally, no such cash is received for issue of shares. These shares can also be issued either at par, at premium or at discount, and the number of shares to be issued will depend upon the price at which the shares are issued and the amount payable to the vendor. The number of shares to be issued to the vendor will be calculated as follows. Number of shares to be issued equals amount payable, issue price. For example, Royal Limited purchase building from Handa Limited for Rs 0.540,000 and the payment is to be made by the issue of shares of Rs 0.100 each. The number of shares to be issued shall be worked out as follows in different situations. When shares are issued at par, i.e., at Rs 0.100, amount payable number of shares to be issued equals issue price. Rs 540,000 equals Rs 100 equals 5,400 shares. When shares issued at premium of 20%, i.e., at Rs 120 100 plus 20, amount payable number of shares to be issued equals issue price. Rs 540,000 equals Rs 120 equals 4,500 shares. The journal entries recorded for the shares issued for consideration other than cash in above situations will be as follows. Books of Royal Limited, journal, date particulars LF, debit credit, amount Rs building/C drive 540,000 to Handa Limited 540,000 building purchased. When shares are issued at par, Handa Limited drive 540,000 to share capital A/C 540,000 5,400 shares issued at par. When shares are issued at premium of 20%, Handa Limited drive 540,000 to share capital A/C 450,000 to securities premium reserve A/C 90,000 4,500 shares issued at Rs 0.120 per share. Illustration 9. Jindal and Company purchased a machine from High Life Machine Limited for Rs 0.380,000. As per purchase agreement, Rs 20,000 were paid in cash and balance by issue of shares of Rs 0.100 each. What will be the entries passed if the shares are issued at par, at 20% premium? Solution. Number of shares will be calculated as follows. When shares issued at par, Rs 360,000 equals 3,600 shares. Rs 0.100. When shares issued at premium, Rs 360,000 equals 3,000 shares. Rs 0.120. Private placement of shares. The Companies Act 2013 Section 42 describes private placement as an offer of securities or invitation to subscribe securities to a select group of persons through issue of private placement offer letter. Employees Stock Option Plan (ESOP). A company may offer option to its employees and employee directors to subscribe shares of the company at lower than its market value or fair value at a future date. It is known as Employees Stock Option Plan (ESOP). It being an option granted by the company, an employee may or may not exercise the right to subscribe. Employees' stock option plan falls in the category of sweat equity. Sweat equity being a company issuing the options has to fulfill following prescribed conditions. These shares are of the same class of shares already issued. It is authorized by a special resolution passed by the company. C. The resolution specifies the number of shares, the current market price, consideration, if any, and the class or classes of directors or employees to whom such equity shares are to be issued. Not less than 1 year has, at the date of issue, elapsed since the date on which the company had commenced business, and e. These shares are issued in accordance with SEBI regulations. If the shares are listed, important terms of ESOP. Grant means giving an option to the employees to subscribe to the shares of the company at the predetermined price. 2021-22. Grant date. It is the date of agreement between the enterprise and its employees to the terms of employees' stock option plan ESOP. Vesting, a process to give right to employees to apply for shares of the company. Vesting date, it is the date on which the employee becomes entitled to apply for the shares once he has satisfied vesting conditions. Vesting period, the period between the grant date and the date on which all the specified vesting conditions of an employee's stock option plan ESOP need to be satisfied. Exercise, it means applying by the employee for issue of shares against the option vested in him. Exercise period after vesting within which the employee must exercise the right to apply for shares against the option vested in him in pursuance of the employee's stock option plan. Exercise price, the price payable by the employee for exercising the option granted in pursuance of the employee's stock option plan. Value of option, difference between the market price and the issue price of the security. 1.7 Forfeiture of shares. It may happen that some shareholders fail to pay one or more installments, viz., allotment money and or call money. In such circumstances, the company can forfeit their shares, i.e., cancel their allotment and treat the amount already received thereon as forfeited to the company within the framework of the provisions in its articles. These provisions are usually based on Table F, which authorize the directors to forfeit the shares for non-payment of calls made. For this purpose, they have to strictly follow the procedure laid down. In this regard, following is the accounting treatment of shares issued at par, premium or at a discount. When shares are forfeited, all entries relating to the shares forfeited except those relating to premium, already recorded in the accounting records, must be reversed. Accordingly, share capital account is debited with the amount called up in respect of shares are forfeited, and crediting the respective unpaid calls accounts is, or calls in arrears account, with the amount already received. Thus, the journal entry will be as follows: a forfeiture of shares issued at par, share capital I/C. Called up amount, drive, to share forfeiture A/C. Paid up amount, to share allotment A/C, to share calls A/C individually, shares forfeited for non-payment of allotment money and calls made. It may be noted here that when the shares are forfeited, all entries relating to the forfeited shares must be reversed except the entry relating to share premium received, if any. Accordingly, the share capital is debited to the extent to called up capital and credited to a respective unpaid calls account, i.e., calls in arrears, and 2. Share forfeiture account, with the amount already received on shares. The balance of shares forfeited account is shown as an addition to the total paid up capital of the company under the head share capital under title Equity and Liabilities of the balance sheet till the forfeited shares are reissued. Illustration 10. Honda Limited issued 10,000 equity shares of 100 each, payable as follows: Rs. 20 on application, Rs. 30 on allotment, Rs. 20 on first call, and Rs. 30 on second and final calls. 10,000 shares were applied for and allotted. All money due was received with the exception of both calls on 300 shares held by Superior. These shares were forfeited. Give necessary journal entries. Solution: Books of Honda Limited. Journal. Date particulars LF. Debit credit. Amount Rs. RS banker/C drive 200000 to equity share application /C 200000 application money on 10,000 shares at RS.20 per share received share application /C drive 200000 to equity share capital /C 200000 application money transferred to share capital share allotment /C drive 300000 to equity share capital /C 300000 money due on allotment of 10,000 shares at RS 30 per share banker/C drive 300000 to equity share allotment /C 300000 allotment money received on 10,000 shares at RS 30 per share on share first call /C drive 200000 to equity share capital /C 200000 money due on 10,000 shares at RS 20 per share on is call banker/C drive 194,000 to equity share first call /C 194,000 first call money received except for 300 shares share second and final call /C drive 300000 to equity share capital /C 300000 money due on 10,000 shares at RS 30 per share on second and final call banker/C drive 291,000 to equity share second and final call /C 291,000 second and final call money received except for 300 shares share capital /C drive 30,000 to equity share first call /C 6,000 to equity share second and final call /C 9,000 to share forfeiture /C 15,000 300 shares forfeited forfeiture of shares issued at a premium if shares were initially issued at a premium and the premium amount has been fully realized, but some of the shares are forfeited due to non-payment of call money. The accounting treatment for forfeiture shall be on the same pattern as in the case of shares issued at par. The important point to be noted in this context is that the securities premium account is not to be debited at the time of forfeiture if the premium has been received in respect of the forfeited shares, and the amount of forfeiture shall be excluding premium amount. In case, however, if the premium amount has not been received, either wholly or partially, in respect of the shares forfeited, the securities premium reserve account will also be debited with the amount of premium not received along with the share capital account at the time forfeiture. This will usually be the case when even the amount due on allotment has not been received. Thus, the journal entry to record the forfeiture of shares issued at a premium on which premium has not been fully received will be share capital /C drive securities premium reserve /C drive to share forfeiture /C to share allotment /C and /or to share calls /C individually shares forfeited for non-payment of allotment money and calls made. Note, if calls in arrears account is maintained, calls in arrears account is credited and not the share allotment and /or share calls accounts. Illustration 11. Sahil, a shareholder, failed to pay the money for second and final call of Rs. 20 on 1,000 shares issued to him at Rs. 120 face value of Rs. 100 per share. His shares were forfeited after the second and final call. Give the necessary journal entry for forfeiture of the shares. Solution. Date particulars LF. Debit credit. Amount Rs. Share capital /C drive 100,000 to share second and final call /C 20,000 to share forfeiture /C 80,000 forfeiture of 1,000 shares for non-payment of the second and final call. Illustration 12. Sunina, a shareholder holding 500 shares of Rs. 10 each, did not pay the allotment money of Rs. 4 per share including a premium of Rs. 2, and the first and final call of Rs. 3. Her shares were forfeited after the first and final call. Give journal entry for forfeiture of the shares. Solution. Date particulars LF. Debit credit. Amount RS. Share capital reserve /C drive. 5000. Securities premium /C drive. 1000. To share allotment /C 2000. To share first and final call /C 1500. To share forfeiture /C 2500. Forfeiture of 500 shares for non-payment of first and final call. Illustration 13. Ashok Limited issued 300,000 equity shares of RS 10 each at a premium of RS 2 per share, payable as RS 3 on application, RS 5 on allotment including premium, and the balance in 2 calls of equal amount. Applications were received for 400,000 shares and pro rata allotment was made to all the applicants. The excess application money was adjusted towards allotment. Mukesh, who was allotted 800 shares, failed to pay both the calls and his shares were forfeited after the second call. Record necessary journal entries in the books of Ashok Limited and also show the balance sheet. Solution. Books of Ashok Limited. Journal. Date particulars LF. Debit credit. Amount RS. Bank /C drive. 12,000,000. To equity share application /C 12,000,000. Application money received on 400,000 shares. Equity share application /C drive. 12,000,000. To equity share capital /C 9,000,000. To equity share allotment /C 3,000,000. Application money on 300,000 shares transferred to share capital account and the excess amount adjusted to share allotment account. Equity share allotment /C drive. 15,000,000. To equity share capital /C 9,000,000. To securities premium reserve /C 6,000,000. Allotment money due on 300,000 shares. Bank /C drive. 12,000,000. To equity share allotment /C 12,000,000. Allotment amount received after adjusting excess money received with application. Equity share first call /C drive. 6,000,000. To equity share capital /C 6,000,000. First call amount due on 300,000 shares. Bank /C drive. 598,400. Calls in arrears /C drive. 1,600. To equity share first call /C 6,000,000. First call amount received on 299,200 shares. Equity share second and final call /C drive. 6,000,000. To equity share capital /C 6,000,000. Second call amount due on 300,000 shares. Bank /C drive. 598,400. Calls in arrears /C drive. 1,600. To equity share second and final call /C 6,000,000. Amount on 299,200 shares received. Equity share capital /C drive. 8,000. To share forfeiture /C 4,800. To call in arrears /C 3,200. Forfeiture of 800 shares. Balance sheet of Ashok Limited as on. Particulars note no. Amount RS. I equity and liabilities. 1. Shareholders funds. A. Share capital 129,96,800. Reserves and surplus 26,000,000. 35,96,800. 2. Assets. 1. Current assets. Cash and cash equivalents 35,96,800. 35,96,800. Notes to accounts. 1. Share capital RS. Authorized capital. Equity shares of RS. 10 each. Issued capital. 300,000. Equity shares of RS. 10 each. 30,000. Subscribed capital. Subscribed and fully paid up. 2 99,200 equity shares of Rs 10 each 29 92,000. Add share forfeiture accounts 4,800 29 96,800. 2. Reserves and surplus securities premium reserve 600,000. 3. Cash and cash equivalents. Cash at bank 35 96,800. Illustration 14. Highlight India Ltd. Invited applications for 30,000 shares of Rs 100 each at a premium of Rs 20 per share payable as follows. On application Rs 40 including Rs 0.10 premium. On allotment Rs 30 including Rs 0.10 premium. On first call Rs 30. On second and final call Rs 20. Applications were received for 40,000 shares and pro rata allotment was made on the application for 35,000 share. Excess application money was utilized towards allotment. Rohan, to whom 600 shares were allotted, failed to pay the allotment money, and his shares were forfeited immediately after allotment. A man who applied for 1,050 shares failed to pay first call, and his share were forfeited immediately after first call. Second and final call was made. All the money due on second call have been received. Of the shares forfeited, 1,000 share were reissued as fully paid up for Rs 80 per share, which included the whole of a man's shares. Record necessary journal entries in the books of Highlight India Ltd. Solution. Date particulars LF. Debit credit. Amount Rs. Banker/C drive 16,00000 to share application /C 16,00000 application money received on 40,000 shares. Share application /CDR 14,00000 to share capital /C 9,00000 to securities premium reserve /C 3,00000 to share allotment /C 2,00000 application money transferred to share capital account, securities premium account, and the excess money transferred to share allotment account. Share application /CDR 2,00000 to bank /C 2,00000 amount returned on 500 shares. Share allotment /C drive 9,00000 to share capital /C 6,00000 to securities premium reserve /C 3,00000 money due on allotment. Bank /C drive 686,000 to share allotment /C 686,000 amount received in allotment. Share capital /C drive 30,000 securities premium reserve /C drive 6,000 to share allotment /C 14,000 to share forfeiture /C 22,000 forfeiture of 600 shares of Rohan for non-payment of allotment money. Share first call /C drive 882,000 to share capital /C 882,000 first call money due on 29,400 shares. Bank /C drive 855,000 to share first call /C 855,000 first call money received on 28,500 shares. Share capital /C drive 72,000 to share first call /C 27,000 to share forfeiture /C 45,000 forfeiture of 900 shares of a man. Share second and final call /C drive 570,000 to share capital /C 570,000 second and final call money due on 28,500 shares. Bank /C drive 570,000 to share second and final call /C 570,000 due money received. Bank /C drive 80,000 share forfeiture /C drive 20,000 to share capital /C 1,00000 reissue of 1,000 forfeited shares. Share forfeiture /C drive 28,667 to capital reserve 28,667 Profit on 1,000 reissued shares transferred to capital reserve. Working notes. I. Excess amount received on Rohan's application. Rohan has been allotted equals 600 shares. He must have applied for Rs. 35,600, Rs. 30,700 shares, Rs. Amount received from Rohan equals 700 multiplied by Rs. 4028,000. Amount adjusted on application equals 600 multiplied by Rs. 4024,000. Amount adjusted on allotment 4,000. Money due on allotment equals 600 multiplied by Rs. 3018,000. Money adjusted 4,000. Balance due on allotment 14,000. 2. Amount received on allotment. Total amount due on allotment equals Rs. 30,000 multiplied by Rs. 30 equals 900,000. Amount received on application 200,000. 700,000. Amount not received on Rohan's share 14,000. 686,000. 3. Money received on first call. First call money due on 29,400 shares 29,400 multiplied by Rs. 30 equals 882,000. Application money not received on 900 shares 900 multiplied by Rs. 30 27,000. 855,000. If 1,000 shares have been reissued including 900 shares of A man and balance 100 shares of Rohan, gain on 100 shares equals 22,100. 600 equals 3,667. Gain in 900 shares equals 45,000. 48,667. Less, loss on reissue of 1,000 shares 20,000. Transferred to capital reserve 28,667. Balance in share forfeiture account of 500 shares. Rs. 22,500. 600 equals Rs. 18,333. Do it yourself. 1. A company forfeited 100 equity shares of Rs. 0.10 each issued at a premium of 20% for non-payment of final call of Rs. 0.5 including the premium. Show the journal entry for forfeiture of shares. 2. A company forfeited 800 equity shares of Rs. 0.10 each issued at a discount of 10% for non-payment of first and final calls of Rs. 0.2 each. Calculate the amount forfeited by the company and pass the journal entry for forfeiture of the shares. Illustration 15. X Ltd. Issued for public subscription 40,000 equity shares of Rs. 10 each at premium of Rs. 2 per share payable as under. On application Rs. 4 per share. On allotment Rs. 5 per share including premium. On call Rs. 3 per share. Applications were received for 60,000 shares. Allotment was made pro rata to the applicants for 48,000 shares. The remaining applications being rejected. Money overpaid on application was applied towards sums due on allotment. Shri Chitnis, to whom 1,600 shares were allotted, failed to pay the allotment money, and Shri Jagdale, to whom 2,000 shares were allotted, failed to pay the call money. These shares were subsequently forfeited. Record journal entries in the books of the company to record the above transactions. Solution. Books of X Ltd. Journal. Date particulars LF. Debit credit. Amount Rs. Banker/C drive 240,000 to equity share application /C 240,000 money received on applications for 60,000 shares at Rs. 4 per share equity share application /C drive 240,000 to equity share capital /C 160,000 to equity share allotment /C 32,000 to banker /C 48,000 application amount transferred to share capital excess application money under pro rata distribution credited to share allotment and money refunded on rejected application equity share allotment /C drive 200,000 to equity share capital /C 120,000 to securities premium reserve /C 80,000 amount due on allotment of 40,000 shares at Rs. 5 per share including premium banker /C drive drive 161,280, calls in arrears A/C drive 6,720, to equity share allotment A/C 168,000, money received consequent upon allotment, equity share call A/C drive 120,000, to equity share capital A/C 120,000, first call money due on 40,000, shares at Rs 3 per share, bank A/C drive 109200, calls in arrears A/C drive 10,800, to equity share call A/C 120,000, money received on first call, equity share capital A/C drive 36,000, securities premium reserve A/C drive 3,200, to share forfeiture A/C 21,680, to call in arrears A/C 17,520, entry for forfeiture of 3,600 shares. Working notes: I. Amount received on allotment Rs. A. Amount due on allotment 2,000,000, 40,000 shares multiplied by Rs. 5 per share. Amount actually due on allotment 2,000,000, amount due on allotment, less excess application amount applied for allotment 32,000, amount actually due 168,000. C. Allotment amount due from Chitness. Allotment money due on Chitness is share 1,600 shares multiplied by Rs. 5 per share 8,000, less excess application money paid due to pro rata distribution 1,920 shares 1,600 shares 320 multiplied by 4 1,280. Allotment amount due from Chitness 6,720 according to the ratio of pro rata distribution 40,000 shares 48,000 shares. For 1,600 shares to be allotted, Chitness must have applied for 1,920 shares. 1,600 shares multiplied by 6/5. Allotment money received. Amount actually due on allotment 168,000, less amount unpaid by Chitness 6,720. Amount received 161,280. 2. Balance on shares forfeited account. Amount paid by Chitness 1,920 shares applied for multiplied by Rs. 4 per share 7,680. Amount paid by Jackdale 2,000 shares multiplied by Rs. 4 plus Rs. 3, Rs. 0.7 per share 14,000. Total balance 21,680. Note: premium amount on Jackdale's shares will not be taken into account as it has been received in full by the company. 1.7.1 Reissue of forfeited shares. The directors can either cancel or reissue the forfeited shares. In most cases, they reissue such shares which may be at par, at premium or at a discount. Forfeited shares may be reissued as fully paid at a par, premium, discount. In this context, it may be noted that the amount of discount allowed cannot exceed the amount that had been received on forfeited shares at the time of initial issue, and that the discount allowed on reissue of forfeited shares should be debited to the forfeited share account. The balance, if any, left in the share forfeited account relating to reissued shares should be treated as capital profit and transferred to capital reserve account. For example, when a company forfeits 200 shares of Rs. 10 each on which Rs. 600 had been received, it can allow a maximum discount of Rs. 600 on their reissue, assuming that the company reissues these shares for Rs. 1,800 as fully paid. The necessary journal entry will be bank A/C drive 1,800, share forfeiture A/C drive 200, to share capital A/C 2,000, reissue of 200 forfeited shares at Rs. 9 per share as fully paid. This shall leave a balance of Rs. 400 in share forfeited account, which should be transferred to capital reserve account by recording the following journal entry: share forfeiture A/C drive 400, to capital reserve 400. Profit on reissue of forfeited shares. Transferred. Another important point to be noted in this context is that the capital profit arises only in respect of the forfeited share reissued, and not on all forfeited shares. Hence, when a part of the forfeited shares are reissued, the whole balance of share forfeiture account cannot be transferred to the capital reserve. In such a situation, it is only the proportionate amount of balance that relates to the forfeited shares reissued which should be transferred to capital reserve, ensuring that the remaining balance in share forfeiture account is proportionate to the amount forfeited on shares not yet reissued. Illustration 16. The director of Polyplastic Limited resolved that 200 equity shares of Rs.100 each be forfeited for non-payment of the second and final call of Rs.30 per share. Out of these, 150 shares were reissued at Rs.60 per share to Moyet. Show the necessary journal entries. Solution. Books of Polyplastic Limited. Journal. Date particulars LF. Debit credit. Amount Rs. Share capital /C drive 20,000 to shares forfeiture /C 14,000 to share second and final call /C 6,000 200 shares forfeited for non-payment of final call at Rs.30 per share. Bank /C drive 9,000 shares forfeiture /C drive 6,000 to share capital /C 15,000 reissue of 150 shares of Rs.100 each, issued as fully paid for Rs.60 each. Shares forfeiture /C drive 4,500 to capital reserve /C 4,500. Profit on reissue of 150 forfeited shares transferred to capital reserve. Working notes. Rs. Total amount forfeited on 200 shares equals 14,200 shares multiplied by Rs. 70. Amount forfeited on 150 shares equals 10,500 150 shares multiplied by Rs. 70. Amount of loss on reissue of 150 shares equals 6,150 shares multiplied by Rs. 40. Amount of profit on reissued shares transferred to capital reserve equals 4,500 Rs. 10,500 Rs. 6,000. Amount forfeited on 50 shares equals 3,550 shares multiplied by Rs. 70. Balance left in share forfeited account equals 3,500 Rs.14000 Rs. 6,000 equal to amount forfeited on 50 shares Rs. 4,500. Illustration 17. On January 1, 2015, the director of X Ltd issued for public subscription 50,000 equity shares of Rs. 10 each at Rs. 12 per share payable as to Rs. 5 on application, including premium, Rs. 4 on allotment and the balance on call on May 1, 2015. The lists were closed on February 10, 2015, by which date applications for 70,000 shares were received. Of the cash received, Rs. 40,000 was returned and Rs.60000 was applied to the amount due on allotment, the balance of which was paid on February 16, 2015. All the shareholders paid the call due on May 1, 2015 with the exception of an allottee of 500 shares. These shares were forfeited on September 29, 2015 and reissued as fully paid at Rs. 8 per share on November 1, 2015. The company, as a matter of policy, does not maintain a calls in arrears account. Give journal entries to record these share capital transactions in the books of X Ltd. Solution. Book of X Ltd. Journal. Date particulars LF. Debit credit 2015 amount Rs. Feb.10 Bank /C Drive 350,000 to equity share application /C 350,000 amount received on application for 70,000 shares at Rs. 5 per share including premium Feb.16 Equity Share Application A/C Drive 250,000 to Equity Share Capital A/C 150,000 to Securities Premium Reserve A/C 100000. Transfer of application money on 50,000 shares to share capital and premium accounts consequent upon allotment. Feb.16 Equity Share Application A/C Drive 100000 to Bank A/C 40,000 to Equity Share Allotment A/C 60,000. Excess application money credited to share allotment and money refunded on rejected application. Feb.16 Equity Share Allotment A/C Drive 200000 to Equity Share Capital A/C 200000. Amount due on allotment of 50,000 shares at Rs 4 per share. Feb.16 Bank A/C Drive 140,000 to Equity Share Allotment A/C 140,000. Money received on allotment. May 1st Equity Share First and Final Call A/C Drive 150,000 to Equity Share Capital A/C 150,000. First call money due. May 1st Bank A/C Drive 148,500 to Equity Share First and Final Call A/C 148,500. Money received on first call. Sept. 29 Equity Share Capital A/C Drive 5,000 to shares forfeiture A/C 3,500 to Equity Share First and Final Call A/C 1,500. Forfeited of 500 shares for non-payment of call. Nov. 1 Bank A/C Drive 4,000 shares forfeiture A/C Drive 1,000 to Equity Share Capital A/C 5,000. Reissue of 500 forfeited shares as fully paid at Rs 8 per share. Nov. 1 shares forfeiture A/C Drive 2,500 to Capital Reserve 2,500. Profit on reissue of forfeited shares accounts transferred to Capital Reserve. Illustration 18. O Limited issued a prospectus offering 200,000 equity shares of Rs 10 each at a premium of Rs 2 per share. Payable as follows. On application Rs 2.50 per share. On allotment Rs 4.50 per share, including premium.